Welcome everyone. Welcome to this Market Thursday. We are May the 27th. It's 1 o'clock here in London. And as usual, a quick disclaimer on those webinars as they are not investment advice. This is purely for information. So please do your own research before doing anything and putting any position. I'm trying as much as possible to cover different asset classes, different topics, and trying to help you and share with you some of my knowledge and my experience. So about my experience, I started to work in the industry in 2000. I started as a cash equity trader in Paris. Then I moved to London in 2004, and since then I've been living in London. I work for Griffin Capital Management, first on the long-only product, then on the long-short product. In 2009, I joined Infinity Capital Markets as an absolute return mandate as a prop trader, working there between 2009 and 2018. We joined the company at the start of this year. From 2014 to 2017, I worked for another education company that I left in 2017. We started my own mentoring program in 2018, launched in 2019 the 4x4 video series. And here we are. So thank you again today for joining. For those of you who are watching on YouTube, thank you as well. If you have questions, either you go into the comment section or you send me an email. So today, what are we going to be covering? As usual, we're going to be starting with the situation across asset classes, looking at stocks, credit, commodities, and FX, kind of a market review, looking at the recent performances. Then, once every 12 months, we're going to be discussing the Bitcoin. Why? Because the cryptocurrency world has been under pressure recently. So the whole universe had a very good start, up 100% and more. And many retail traders and even professionals were frustrated for those moves. So that's the fear of missing out. And Bitcoin and the crypto is still a new world for most of us. So I wanted to look at how Bitcoin have been doing in the past, looking at the recent drawdowns. And as well, more importantly, looking at understanding the risk-adjusted return. And my conviction is still that if you're managing money, the most important thing is the risk management. Then we're going to be talking about the bonds versus stocks and something that I discussed in the 4x4 video series, which is the 60-40 portfolio. So the 60-40 portfolio was and has been for years the benchmark with 60% equities and 40% bonds. So that is something that has been working pretty well. Why? Because bonds have been enjoying for the last 20-40 years a nice bull market. So that was a win-win, and the performance have been pretty stellar for most of those 60-40 portfolio. Having said that, with yields now, or at least for the last couple of years, which were close to negative yields or negative in negative territories, the upside was and felt a bit limited. And the recent sell-off in the bond market that we had over the last 6 months is challenging this 60 to 40% portfolio. As usual, quickly looking at the catalyst. We are talking short-term, mid-term. Short-term, we get tomorrow the PCE. So PCE, for those of you who don't know, it's more or less the CPI, which is the inflation in the US. So the market has been concerned by inflation since the start of the year. Inflation is above the 2% target of the Fed. That is true for the CPI, which was at 2.8 or 2.9% or above, and the PCE is expected tomorrow. So we'll see how the market is going to react. The last CPI, despite being in line, the equity market sold off. So that was actually the market that reacted the most at the inflation, despite this number being more or less in line. We got a long weekend, so the market is closed in the US on Monday, same in the UK, but more importantly in the US. So long weekend, that means that the PCE is coming just before this long weekend. If we look as well over the next couple of days, we get the potentially some end of the month rebalancing. Why? Because mutual funds are very often rebalancing their portfolio and their positioning. And then later in September, not in September, it's only June. Later in June, on the third Friday, we're going to have the big expiry, the big quarterly expiry, which is always very important. This is the one that is quite big because it's just before the summer, which normally is pretty quiet. Plus, in terms of special situation, you get the index rebalancing with some stocks going in and some stock going out. Plus, more importantly, the Fed and the ECB meeting, which might be giving us a bit more color about tapering after this massive run of this balance sheet increase. So as usual, let's start with asset class performances. The good thing about Bitcoin coming down, and I'm sorry for those of you who are long Bitcoin of crypto, is now this chart looks much better because crypto is not destroying here the chart overall. So Bitcoin, after being up 100%, and so it's only down 30% something. So that was as of yesterday. What is interesting still is the equity market, the stock market, is roughly up 10%, and that's worldwide. So we are up 5 to 15%. So the equity market, the stocks have been doing pretty well. If we look at the second part, which is currencies, there has been a lot of noise as usual with currencies. I'm not an FX trader, as you know, probably now. I trade from time to time FX. I don't like this market very much because there is a lot of noise, not that many opportunities. And if you look at the ratio of noise versus trade, that is pretty bad. And if we look at the dollar versus most currencies, the dollar is down, 2 to 4 to 5%. If we look versus the euro dollar / the DXY, which is making 60% of it, it's pretty flattish. But we are trading sideways, still dollar being a bit negative. On the what is making the headlines, starting to make the headlines, is actually the Chinese yuan, which is the here. Either you look for the offshore or the onshore, is making new highs. So the yuan is pretty strong versus the US dollar. We are trading below the 6.4, which is, I think it's the level that we had in 2018. Right hand side, WTI still pretty strong. We are trading around $65 something. Next slide, which is the week to date. The week to date tells you that we had a nice bounce over the last 5 days. And which coincides with the lows that we had on the last Wednesday, which was the VIX expiry. That's something that we're going to discuss a bit later. Currencies flattish and WTI up. So now about the different sectors, year to date and week to date. Top of the leaderboard is the energy, followed by financials, utilities. Anything that is bond related has been struggling a bit. You can see as well that technology has been not as strong as the overall market. So what has characterized this market year to date is some rotation from big caps to small, from growth to value. So anything that has been value has outperformed the growth year to date. There has been a bit of rotation where growth over the last week has been doing quite okay. So if you see here the IT 3.2% versus the S&P. So there has been a bit of a start of an outperformance from the technology sector. What I found interesting, especially this week, is all the dodgy names. The memes names, the Wall Street bets names that were on the tier in January, the stocks that were heavily shorted, have been doing very well. So market is much quieter. So the volumes in terms of options and even the cash is pretty low. Having said that, there is a lot of retail traders are back again. There is a lot of call options traded on those few names. So the names of like AMC, GME, the most heavily shorted names have been on the tier. That was true yesterday. That was true the day before. That tells you that maybe the quality of the underlying market is not that great. So people are just struggling to find direction. And as we're going to see when we do technical analysis, price action, market in reality has been trading sideways. Most markets have been trading sideways for a couple of months now. Next one, this one is always important. It's looking at the other asset classes. The VIX is not an asset class. It's just, it's easier for me in terms of presentation to put the VIX. So the VIX is at 17% roughly. As I said before, last week, exactly 6 days ago, just before the open and on the open, the VIX was trading around 25 to 28%. Always put in your calendar when are the VIX futures expiring and where are the big option expiry. There was a funny tweet from someone who keeps on saying, I want to be short. And actually on the Wednesday of the open, he said, guys, you should be short QQQ through put. Unfortunately, if you are a portfolio manager and you push people to do so, when the VIX is at 25 or above, and the implied volatility has been moving much more in reality than the underlying, that means probably you don't understand options and you don't understand the underlying. So again, that is, when you do options, a very important component of the option is the implied volatility. If you buy a put with a 25% implied volatility, that is very different than a 17% implied vol. And I guess not only if the market goes up, you're going to be killed on the underlying, but you're going to be killed because the implied volatility is coming down. Second one is the bonds. Bonds, and we're going to be checking it later, have been coming down a bit. So there has been a lot of noise of, inflation. So it feels like, retailers, and actually, if you do some Google search, that inflation search has been on the rise. Even the ECB put in place a tool to check inflation. So inflation talks are everywhere. So if it's everywhere, that is probably fairly priced in the market. And as you can see, when we're going to be checking the US 10 years, it has been, the yields have been coming down a bit. So we are at 1.6%. So again, bad ratio between noise and reality. In terms of stocks, top winners and top losers, again, this is something that I mentioned, all the SPACs, heavily shorted, Wall Street bets have been on the tier. So the Twitter influencers are probably back again. This is not necessarily a good market to trade when you look at those names. On the top losers, this one is interesting, which is GSX, something that we discussed again, is trading below $20. As I told you, some short sellers were pushing the story as a short. They have been very successful. I tried last year. I didn't get the risk management right, but the bottom line of this is if you follow some short sellers, there are some good guys out there, and they can help you generate ideas, or actually they can help you save money if you're long those names. Next one, as usual, the central banks' balance sheets, because they are the key players in our markets. So the Fed balance sheet and the ECB balance sheet are still on the rise, same kind of pace. Now there is a lot of talks about tapering, coming into at least tapering talks, starting in June, maybe effective from September. Why? Because our economies are doing much better. And I'm not an economist, but there is a bit of imbalance between the level of money in the system and what the economies are really needing. Let's go into, if I manage to switch from price action, so my price action here. Okay, so as usual, starting with the VIX, there is no technical analysis on the VIX. It's just to get a feel of where the implied volatility has been and where it is. So we are below the 19% level, which is the average from the since its creation. Again, we had the spike last week on some fear and probably on some bad positioning on the VIX future. Overall, we are in a very different level of VIX than before. If we look at the S&P futures up, so here you do ES1 on TradingView if you get access to TradingView. So this is the chart, and I'm going to be doing a regular chart, which is going to give me that picture. So we have been testing this trend that we have since the beginning. Actually, this is not a bad one to trade because it's still trading in this range. So if it goes in the upper range, you know, you start to reduce exposure or start to have a small short position. But overall, what is interesting is if you look at the timing over the last couple of months, we have been trading sideways. And as we're going to see for many other asset classes and assets, if we look at the Nasdaq Composite, this is the same picture. We have been trading sideways. So that is even more true for the Nasdaq, which has been trading at that level since January, February. Recently, we made a bit of a new highs, but there is no strong pickup. It's not, people are struggling to find new leaders. When I say new leaders, is stocks companies that are able to push the market higher. And that is why the market, you know, is trading over the last quarter at this level. Next stock, sorry, will be the Russell. So we go from general indexes to the other. The trend that we started at the election time. So here, that's the bottom of the market. Then we had at the election this big move. And we, again, consolidation after this big move. Market is really struggling for direction. Why? Because we get the ECB, the Fed the potentially tapering. We get inflation. The earnings have been pretty good. But still, you know, after this massive move up, market is still digesting. If we look at Europe, because from time to time, it's good to be looking at Europe. Europe has been trading in this trend channel, similar, you know, as long as you're in this channel, the move is up. As a European and trading Europe, I'm always concerned when I see more and more people saying, oh, actually, I want to go long Europe because I think this is opportunity and there is a good thing. It reminds me when everyone was telling me or telling European traders to buy Italian banks. And after that, you know, they went down 50%. So people are really struggling to find momentum. And when they start to push for Europe as a momentum story, there is always a concern. Next one is IWO versus IWN, just to give you a bit of color of values versus stock versus growth. So IWO will be the Russell for growth, and IWN will be the Russell for value. So last year, growth was benefiting massively. As you can see, the move, we went from 160 to 20. Then we came back recently. Why? Because fear of inflation, yields going up. And what you do, you sell growth and you buy value. And as I've been telling you over the last 1 week or two, there is a shy try of growth trying to bounce from this sell-off. I still believe that, you know, we're gonna go around this level. This is the way to go forward. Another chart that I find interesting from time to time, I tweet on it, which is the Philadelphia semiconductor. And here the trend has been broken, so I go into logarithmic. So semiconductors making the headlines, talking a lot. There's a lot of noise. I think this morning NVIDIA came with some expectation for Q2, which are way above the market. But still, we are in a consolidation phase that started in January. So the market is really struggling for leaders. So if you've been playing momentum growth strategies breakout, that have been the strategies that have been quite struggling over the last 3 months. Let's move now into bonds and looking at the US 10 years yields. So here, we are trading at 161%. And that is the level that we have since March, start of March. So we have been trading between 140-ish, 150 to 175 consolidation. Again, over the last couple of months, a lot of inflation talks. What was interesting is when we had the CPI, which was way above the 2%, actually bonds didn't react that much. So we had a sell-off in equities, which was pretty weird, not weird because, you know, I think when you have a headline number like this, the market is overreacting. But clearly the equity market was the market that reacted the most to this inflation. Again, tomorrow we get the PCE. This is even more important than the CPI because the Fed is looking at the PCE as its metric. So a big number tomorrow, but the US 10 years, this is where we are. We are back to the level pre-crisis. There is no real follow-up. If there is a quick move into the 2% and above, it's really the speed of the move that's going to scare the market, the equity market. As long as you move slowly but surely, hand in hand with the economy doing better and some inflation, equity market should be doing fine. If 10 years versus 2 years, not necessary. Let's look at euro dollar. Euro dollar, as I've been saying, you know, since we broke this 118, we are consolidating. No, I don't have real view. The long-term chart is telling you that the long-term chart is telling you that the euro should be strengthening, meaning the US dollar weakening. But at the moment, there is no real momentum. So as a momentum play, I don't find it interesting, which is the same chart as the DXY. So we broke this big trend. Now, not really a big move. USD, something that I just mentioned before. So that is versus the Chinese yuan. So you like it's a nice painting that I've done for you here, but we are making new highs for the Chinese yuan. So the next level is 626. So the US dollar is really, I mean, it's not really, but it's weakening versus most currencies. That is still the play, which is not a bad thing for US equity and for US companies. And as usual, in a world where everyone is trying a bit to weaken its currency, there is always a limit to it. I remember reading somewhere that you know, some level could be 130 on the euro dollar. Here you can't be blaming the Chinese to weaken the currency too much. Will they be happy to have the currency at this level? That's another question. Quickly, we're going to be looking at some commodities. And for those of you who don't like price action, and let's do for the two, price action and technical analysis, then you know you can skip, especially if you watch on YouTube. So this is the 60.5 level, which is a strong level on the WTI. For the moment, we are fighting against that level. if it goes, it's going to go quickly. So if you like the breakout story, that is one to watch. You put an alert around 65, 50, 67, and then it's going to go. Next one is actually something that was so far, I'm struggling. The copper. So copper, Dr. Copper, the trend is still your friend, so we are still trending higher. Having said that, interestingly, we are roughly down 5 to 7% from the new highs. I don't know if you saw that, but you probably saw that. But China, is really trying to reduce the access to credit. So when you reduce access to credit, there is a strong correlation between credit and the commodities prices. Actually, there's some good charts from some Twitter accounts. So I put those charts in the community, on the community chat yesterday. Strong correlation, but that has impact on obviously the price of currencies, and there are some impact as well on the prices of cryptocurrencies. So China, which has been pushing many asset classes, might be trying to reduce the speculation, and you can see that on some commodities. That is true for the copper, but that is true for wheat. That is true for agriculture commodities as well. The next one, and it's going to be the last one, which is the gold. I don't know if that's the good chart. So gold trading around 1900, which has been breaking this. I don't know if you call that in technical analysis, and to be honest, I really don't care. Is it a pennant? So it's trading above. There has been a bit of recent strength and momentum into the gold, and you can argue that this is a bit of a revenge from the gold holders versus the crypto holders, because gold has been doing pretty well. Okay, this is it for price action technical analysis. Let's go back to the slides, and we're going to go into the Fed expectations. As always, we are looking at the euro-dollar futures. If you don't know what are the euro-dollar futures, go on Wikipedia or try to find another webinars that I've been doing, or you can subscribe to the 4x4 video series. And it's more or less telling you how market participants are expecting the Fed to be doing in the futures. And so this is from a couple of weeks ago here, and that was as of yesterday. As you can see from that space, from the September 2022 to the September 2023, euro-dollar futures are up 5 to 10, meaning that the Fed, the expectation for the Fed to hike rates have been lowered quite a lot over the last couple of weeks. So if you look at the December 2022, which is at 99.64 now, so probably we get a chance, 90% chance of the Fed doing something in December 2022, but again, it has been lowered. So talks a lot of inflation, be careful, inflation, and actually the market is pricing less inflation as the noise is saying, and that is true as well. If you check the break-even 10 years, which you can do on the Fed website, the break-even 10 years has been coming down a bit. So inflation expectations coming down. Here, what is it important still to look at the Fed at those expectations is because tomorrow we get the PCE. So the PCE, or the personal consumption expenditures, with data expected tomorrow. As we see here, like the most recent CPI due based on the calendar effect year on year. So year on year, everything was closed in March, and afterwards in April, everything opened again. So it was closed, and because 12 months later everything is opening, we get this massive calendar effect. So the survey is telling us, the 3.5% expectation, which is way above. So that's the pink chart here. that tells you that it's going to come way above. If you look at the PCE core, the 2.9% here, that is above our 2%. And the question that the market, and I've been quite asking during those webinars, is inflation transitory? There are many things that tell us that it is transitory. Why? Because the world is reopening. And there are some other things that tell us that actually it's not going to be only 3 to 5 months. It could be longer than that. And if that's longer than that, that means Fed, central banks will have to adjust. As I've been saying, China has been pretty active recently to try to reduce inflation by limiting the access to credit. And that is very important to look at the correlation between M2 or access to credit and how the economies have been doing. There is always a strong correlation. If you put liquidities in the system, economies will be doing pretty well. ECB expectations. So I wanted to do a bit of ECB expectations because I think there's not only the US. We can be looking at Europe as well. You can be looking at the Euribor futures, which is not the perfect way of looking at it, but still, you know, let's try to do something simple and don't go into the swaps and all of this. So the Euribor is the basic rate of interest used in lending between banks and the European Union interbank market, and also used as a reference for setting the interest rate on other loans. So this is a 3-month Euribor futures. I like this website. Why do I like this website? Because this is the same as for the Eurodollar futures. I can see what the market is expected from the ECB in the futures. So as long as we are at 100.5, that means we're expecting the ECB to do nothing. So you can see in June 22, nothing. We start to have something in June at 100.4, meaning that we need to wait another couple of years for the ECB to hike rates by 10 bips, only 10 bips. So there is a long way to go before the ECB will be doing something. We know that most of the time, the ECB and the Europeans are following the US by, you know, it's going to take 3 to 6 months. So if the Fed does something 6 months later, guess what? The ECB do something. And guess what we've seen before? We've seen that the Fed will be doing something by hiking by 25 bips, probably in December 2022. If you take 6 months later, that is June 2023, and this is when the ECB is doing something. So maybe we don't need necessarily to have the ECB, and we just need like the Fed to be running a European department, and that be it. Bitcoin. So Bitcoin, normally don't talk too much about Bitcoin. Just if you be watching the webinars, included Bitcoin once it started to be at 12,000, because I think technically that was a good sign. And I put it into the asset performances. What I find interesting is the recent top in the Bitcoin market went exactly on the same day of the Coinbase listing. So there are some idiots that will tell you about other things, about, you know, conspiracy. But very often when you are into an industry, into a sector, there is a strong correlation between the moment there is a placement, there is an IPO, there is here direct listing, and since then, the market has been coming down. So the Bitcoin, where I was interested is looking at the drawdowns since 2010, since its creation. I'm not necessarily talking about the fundamentals, if there are, of the Bitcoin, but more as a risk reward and as a risk profile of this. I don't know if that's an asset for some of you, it's going to be an asset, but of this product. So the drawdowns, if we look at the biggest drawdown, we had 80% more, or roughly 80% more, 3 times already. So at the start, you can argue that it was very small. Still, Bitcoin is small. Actually, here it was already bigger. So third drawdown, the recent drawdown is only, and I'm sorry for that, is only 40 to 50%. So versus history, that is not the end of the world. But having said that, I have to say, when an asset goes down by 50%, here we have an issue. What I'm interested here as well is looking at the, so here this is the monthly high minus the low divided by the low. As you can see as well, on many months, during many months, it's going to be moving by 40% between the lows and the highs. So what does it tell you? This thing is moving like there is no tomorrow. Okay, you knew it already, but it's easier when we look at data instead of saying, oh, it's moving a lot, and not knowing, you know, what have been the drawdowns, what have been the recent volatility. So the Bitcoin, if you look at the daily ATR, which is a good way of understanding what has been the intraday volatility, I compare that with the S&P in blue. So S&P in blue, where the daily ATR is going to be 1-2%, whereas the daily ATR from the Bitcoin recently has been, you know, 15 to 20%. But before that, you know, we were around the 10%. Again, that tells you that if the S&P is moving by 1 to 2%, Bitcoin is moving 7 to 8 times more on a single day. What does it tell us? Your risk management should be completely different. For me, as let's go back here. No, that's where I want to go. My background and I believe that the stock market is where you have the most opportunities. And even if I know that the Bitcoiners and the crypto guys are not going to be loving this comparison, what I like to say is, if you take the Bitcoin at 40,500, which is up 40% year to date, and that was, you know, as of yesterday, and probably it's changing every day. If you take the US universe, okay, you're gonna have 204 stocks that were up 40% plus, meaning as much as the Bitcoin as of yesterday. So what does it tell us? It tells us that there are opportunities. Bitcoin, I understand the size, which is $500 billion in terms of market, but this is one underlying. Whereas if you look at stocks, you're going to have 200 names plus in the US that have been performing as much as the Bitcoin. You're going to have 76 US stocks that move more than 60% year to date. So, you know, the old Bitcoin used to be retail traders trading FX like with huge leverage. So people were coming and saying, you know, I'm going to be trading euro, dollar, whatever. And instead of having an ATR on a big volatility, they were using 100 times leverage. Having said that, they are still using this big leverage on Bitcoin. But your universe in terms of opportunities is still very small. Okay, if you look at FX pairs, you are talking 10 to 20 that you can be trading easy. Here, if you look at the Bitcoin and other cryptocurrencies, we are talking 10 to 20. If you look at the US stocks universe, 3 billion market cap and above, you get 2,000 opportunities. You get 1,000 in Europe, you get 1,000 in Asia. And those stocks are going to be doing well. So bottom line is, you know, Bitcoin, maybe, but there are many other opportunities. Now, I would like to talk about, you know, the Sharpe ratio, and I compare the S&P 500 versus the Bitcoin. So Sharpe ratio, probably some of you know what it is. If you don't know, you go on Wikipedia, or you buy the 4x4, which is even better. But it's not perfect, but it's okay to understand the risk return, the risk-adjusted returns. So the Sharpe ratio more or less tells us how much excess return we get for the extra volatility. Okay, it's not perfect. Why? Because there are some issues, especially because on the denominator, it's the volatility, and it's not taking into account in a good way when there is up volatility. But what is this slide telling us since 2016, okay, the Sharpe ratio of the S&P 500 is at 1. If you look at the Bitcoin, it was at 2.7%. But if you do the same thing and look at the Sharpe ratio of the S&P and the Bitcoin since 2018, the numbers for the Bitcoin has been coming down massively. So what does it tell you? It tells you that we went from 2.73 to 1.28. And there is a deterioration in the risk-adjusted return of the Bitcoin over the last couple of 2 or 3 years. Meaning for us, as money allocator, we are looking at the best risk-adjusted returns. And this one clearly tells us that Bitcoin is not as good as before. It's just data, and I'm sorry, and I don't want people to come back to me and say, oh, Bitcoin, blah, blah, blah. This slide is an interesting one, which is from PwC. So PwC, if you go on their website, every year they do a survey around cryptocurrencies fund managers. And this survey was done when the Bitcoin was at $59,000. And obviously it's back to the dollar, it's versus the dollar, $59,000, asking crypto hedge fund manager, where do they see Bitcoin at the end of the year? And guess what? Guess what? Everything should be, most for them, above 50,000 US dollar. So if you are a bit of a contrarian, if you think that market participant analysts most of the time are going to be wrong, and this is a plain example of it. By definition, people who are running crypto are long the underlying. Okay, very few people will be long short, more into that space, which is very long story. So what they want is and they believe massively, because they want to sell the product, that the Bitcoin is going to go up. So here, I think, for many retail traders, that has been painful. So if you look at who gets slaughtered recently, that has not been the institutions or the so-called educators. Institutions, they are just starting to allocate money into that space. So if you are a big BlackRock of this world and you are running trillions and trillions, and if your asset under management goes from 0.1% on 0.2% into Bitcoin, that means, or crypto, there's going to be a lot of inflows going into crypto. So this world of crypto is going to go up. But if it goes down by X, that is not that painful. If you look at the educators, and there was funny videos when Bitcoin was down, to 30,000, there was on this guy on Twitter, driving his car and saying, everything is fine. And the guy is supposed to be 100% long the crypto. And you're like, when I got a position and my position is down 15% on the day, I don't feel well. So what does it tell you? Those guys are not making money trading the crypto or being long the crypto. They are making money in selling education, selling stuff, whatever you want. So if you pretend to be fine when your asset is down 30 to 40%, don't tell me because this is a long-term story, blah, blah. It's just because you don't have any risk management. So third point, the size of crypto world versus the other opportunities. My conviction is, the world in stocks, you get many opportunities. You can, from time to time, trading FX, you can be trading commodities. But if you are only trading one product, then there is no diversification and you put in all your money at risk, because suddenly, if there is a big move like this one, or if there is no momentum, you're sitting on your hands for too long. That tells you as well that limiting your downside is key, but taking your profit is important as well. So I know what people are going to tell me, which is this part about trading psychology, which is fear of missing out, the hodler, meaning, keep the crypto, is going to go to the roof, I carry on keeping it. Reality is many retail traders enter the market, so people get killed. I have many mentees that came to me because they get washed out in 2018, 2019. Then they rebuilt their portfolio and they rebuilt some capital. And now we get the second wave of people that entered, retail traders that entered all those cryptocurrencies between January and March. They lost 30 to 50%. The thing is, as I said, institutions, they don't really care. They are still going to be allocating money because crypto are still so small. If you're worth, $1 billion, if you put 10 million into crypto, that is 1% of your asset. That is still very small. But if you have people coming, by definition, the pool of people buying is going to get bigger. But for me, last week I've shown still the big issue of this market, which is, the market access, the counterparty risk. So on the sell-off just before the US Open, when the Bitcoin went to 30,000, all the markets were closed. So when I asked 6 months ago, how can I be trading the Bitcoin? I had many people telling me, oh, Greg, you're too old. It's very easy. You need this and this. Reality, first, it's not that easy. And secondly, there is still a massive counterparty risk and execution risk. So that means for me as a risk manager, it is not still ticking the boxes. And this is why, this market is still offering above average returns and is having still wider spreads versus the other market. So if you want to take this as a positive, you can argue that this market is still learning and growing, and in the next few years, it's going to get better. So it's not only negative what I want to say, it's just I want, retail traders that are listening to this call on YouTube or today, that, risk management is key here. And the noise is way too much. So next part, bonds versus stocks, where here we'll be looking at the monthly S&P returns versus the 10 years US yields monthly change correlation. So let me explain a bit more in detail where we started in January 62 to December 65, where we have a low negative correlation. Then from January 66 to June 1998, we get a negative correlation. So when stocks goes up, bonds goes up. From July 1998 to March 2020, we get a 0.33. So that's a positive correlation between yields and stocks, meaning that you have a negative correlation between bonds and stocks, meaning, in other words, when stocks go down, bonds go up. But since the start of the year, and actually for the last couple of months, there has been a negative correlation. So, in other words, let me translate that to you. And let me give you an example here from July 1998 to March 2020. We have a positive correlation between yields and stock. Okay, so at 0.33, this positive correlation between stocks and yields means from during that period when stocks are going down, yields are going down and bonds are going up. So when you have a negative correlation, that is normally a great way for investors to hedge their exposure in stocks when risk on, when there is a risk on, risk off. Okay, so you go long when stocks are selling, bonds should be higher, and this is why the 60-40% portfolio allocation was working well. But if the correlation is broken, how can we be hedging our portfolio? Okay, and that has been the struggle recently. How can we be hedging our portfolio? And that might explain as well why recently market participants have been buying massively some put, and that implied volatility on the downside has been jumping much higher than usual. This chart is from BCA, which tells you, so here you can divide the time in two here. Okay, so after 1997, you can see that the positive correlation between stocks and bonds disappear when there is a change in the market perception from market participants, especially when inflation is going higher. Okay, so that's the US tech bond correlation. When the core CPI, which is here, so here you get your CPI. As long as the CPI is below 2%, we are fine. If the CPI is above 2% or inflation is above 2%, then the correlation breaks. And that is similar here to that chart that is that I found from UBS. When there is high inflation, which is the limit here, the 2.5% inflation, You look at the correlation, which is here. When there is inflation above 2.5%, or that should say this is the threshold where stocks and bonds go from negative correlation to positive correlation. Meaning what? That means if stocks sell off, bonds are selling off as well. So there is no protection. So everything goes hand in hand if you look at history, CPI or inflation is at 2.5% for too long. So really the big question is, are we going to stay at 2.5% or above for too long? And if that's the case, then actually for your risk management and your allocation between stocks and bonds, that is an issue. And that's what we had between 1980 and 2000. I was not trading at that time, so I'm just looking at history. But that is where the market has been struggling over the last couple of months. It's this decorrelation, or I should say this correlation between the bonds and stocks recently. So here I just wanted to give you the chart of the core CPI. A better one would have been the core PC. So again, if we stay, so here this is since 1968. Since 1968, as you can see, we have been below this 2% over the last 20 years. I don't think that we are in the world of hyperinflation, and we're going to go into the 5, 10, 20%. Maybe I'm wrong, but you know, still, if you are above around 3% and above for too long, clearly that puts the nice way of doing the construction and diversification, meaning that again, the risk on, risk off with bonds is not helping anymore. So if you think about the amount of money that has been placed over the last 20 years into the bond market is much, much bigger than the equity market. If you think about the allocation that has been put into passive investment, that means if you need to reallocate this money, it's going to be taking a lot of time, and the inflows and outflows are going to be quite massive. Again, for the time being, it might be only the start. Inflation is still, if you look at what market participants and what the market is telling us, is we're going to be at 2.5% something, and there is no fear that inflation will be spiking too much too quickly. Looking quickly at education. So as I say, usually now you have access to a trading community if you've been doing the 4x4 video series and or the mentoring. So as you can see, from time to time, we discuss the Bitcoin. So I try to give ideas, to give some content that goes on top of those webinars. And the good thing is there are more and more interaction and people coming with ideas as well. So community is building. This is a long-term project. I'm not going to give up. Next one is the 4x4 video series. Go on the website. You know probably what it is. This is an investment process with video access, Excel spreadsheet. Then we have the mentoring. I have 3 people that are ending the mentoring on Saturday, so I'm going to be pretty busy. 2 from Australia, 1 from the Middle East. So pretty effective. It works very well. You learn a lot, hopefully, and it's about helping you building your infrastructure, generating ideas, building your track record if you want to have access to the industry, or if you want to just raise money. For more information, you can send me an email. You can go into the comment section. If you're on YouTube, you can follow me on Twitter. Quick question, I think, from Andrew. To join the community, you should have done either the 4x4 or the mentoring program. So there is one section for the 4x4 and one section for the mentoring program. This is it for today. Again, long weekend. A lot of talks about crypto. I mean, crypto is a world where there is a lot of people pushing for it. Is so-called educators. Be careful. Understand that people were very frustrated not making money, And I had so many people coming to me and say, oh, look, Greg, this guy is up 40, 50. I'm only up, 3, 5, 6%. What should I be doing? So all those guys, most of those guys are sales traders. So they used to be sales traders at banks. And when I say sales traders, 90% of their P&L was about selling things. So be careful, try to read between the line, look at any asset, any underlying first at how to do the risk management. And then for the bonds versus stocks, I hope it helps trying to do those education calls. The next webinar is probably not going to be in a couple of weeks, because in a couple of weeks I'm getting 1 year older. So maybe in 3 weeks time or before or after, we'll see. Again, if you have any questions, if I can help you, if you get questions about the 4x4 video series, about the mentoring or the community, feel free to send me an email. I hope it helps, and I'll see you in June. All the best, everyone. Bye-bye.